One of the hardest things in the world is founding a company and building it. You have to create a universe out of thin air and then start inviting others into it to believe in it and take part in it and like grow that universe into reality. And then you're kind of like learning your strengths and your weaknesses and supplementing that with like knowledge and training and growth, but also team members.
Tim Young is a top venture capitalist and exited founder.
Over the past 25 years, he has invested in hundreds of early-stage companies.
What do you look for when you're deciding to invest in a startup?
Well, I'd like to say it.
Welcome back to Decoded. My name's Alfie Whattam, and this is the show where I speak to experts about what it takes to build great teams and companies. Make sure that you click the follow or subscribe button for more great content like this, and I hope you enjoyed the episode. So Tim, you've invested in so many massively successful companies. What do you look for when you're deciding to invest in a startup?
Well, I'd like to say it. I invest very early, right? I invest pre-A, so it's seed. And there's still a lot of risk associated with companies at the stage. You know, the lion majority of companies formed at that point, I'd probably say like 95% fail. And, you know, at ENIAC, we, have, much higher conversion rate to some outcome or success or unicorn. But so it's very early. So team is like a huge part of what we're looking at. Really, like, frankly, the idea that the founding team brings to me is just one data point for me to evaluate the team at large. It really is predominantly team bets. Even if they have a product and they have traction, it's still all of that just kind of de-risks the team more for me. And so I'm really about making team bets. I wrote an article about this in Forbes and kind of like how you present your team to VCs, and then that kind of illuminates like the things I'm looking for. But I love repeat founders. I mean, the learning curve of one of the hardest things in the world is founding a company and building it. You have to create a universe out of thin air and then start inviting others into it to believe in it and take part in it and like grow that universe into reality. And it starts with co-founders, and it starts with engineers, and it starts with employees, and then investors, and then more investors, and more employees, and then lieutenants, customers, obviously, along the way. And that journey is hard. So storytelling is a part of it. Storytelling, and like back to what I was saying, like the learning curve is like nearly vertical when you're doing this, when you're founding a company, and it's so difficult. There's so many things to learn at the same time, right? Like, as a founder starting off, like recruiting is huge. You're managing people, you're managing a budget, you're flying you're literally like building a parachute as you're falling to the ground in terms of financing. So like,
Yeah.
You gotta learn finance, you got to learn product, you got to learn, a little bit of engineering, a little bit of front end design, a lot of go-to-market, a lot of marketing, a lot of customer success, like all of that. And founders usually will have components of that in their background, but never like everything until you found a company. And then you're kind of like learning your strengths and your weaknesses and supplementing that with like knowledge and training and growth, but also team members. And so when you do that once, the first time, you learn a ton. And this is not for everyone, and it's not for the faint of heart. So a lot of people will try once and then they're done. So if you find a team that's done it once, and then success or failure, they want to do it again, that means that they really have, I think, what it takes, at least like spiritually and like intellectually and emotionally, to kind of go at it and try to make it work. And if they had any degree of success, if they build a product that got some traction, and they built a team that, had some traction and went through like an exit, of some nature, that journey, the knowledge on that journey takes that learning curve from vertical down to like here. And from here to here, when you're in a competitive market and execution is a big part of it, is really material and significant, and at times priceless. And so I love repeat founders. And then back to other church, like I love storytelling is really important. Like you need to be able, again, to create this space, invite people into it, in a that is never, and that storytelling never ceases to be important. Like building product is a form, like the UX of a product is in a way storytelling. Selling that product to customers, selling the company vision to not only investors but employees, keeping churn down during hard times at the company is storytelling. And then eventually like courting, M&A potential, acquirers, or, banks in the street to go public. It's all storytelling. So it's, it's an underrated, and I think it's something a lot of good investors intuitively understand, but I think it's underrated in that articulation. Integrity is really important. Like, you have to be forward leaning, you have to push boundaries, but trust is fundamentally important, like with your investors, with your employees, with your family. So integrity is really, really important. Just like work ethic, just like charging as hard as you possibly can in a sustainable way that isn't going, and so many founders, especially when they're young, they get like really fired up and they just go for it, and they're going, and they're like staying up late, and they're accumulating debt. I wrote another book about this, about just like the debt of, you're always accumulating debt as a human that's like high functioning and really going for it. And that could be in the form of like health debt, sleep debt, relationship debt, mental health debt, vacation, actual financial debt at times. And so there's all that you have to, you're investing your time certain places, and you need to overinvest to make things work as a founder, and you need to underinvest other places, and that creates debt. And so you have to be able to balance all of that, and you balance your personal life, and everything else, especially as you get older. And so like, just running as hard as you can, not sleeping, not exercising, and hitting a wall does no one good. Doesn't help you, your investors, everyone relying on you. Decision making is so important, right? Like I often say that the first, like a company's trajectory is, by and large based upon like $250,000 to $500,000 decisions that the founders are going to make, over the course of 5 years. Every one of those decisions increases or decreases the value of the company. So you need to be well rested, exercised, fed, de-stressed, to maximize your ability to like make good decisions. So I'll pause there because that's a lot, but that's a little taste for some of the things that I'm looking for when I'm placing a bet with a team.
No, certainly that was excellent. And when I asked your co-founder the same question, he gave me exactly the same answer, and that team is the most important thing. So it's great that you both have exactly the same opinion. And I agree with you. When I'm doing angel investing, repeat founders are wonderful because they've been through the pain, they've been through the struggle, and they're crazy enough to want to go and do it again, which is always a good sign. And that storytelling, having that reality distortion field, if you don't have that, then and you're not able to convince early employees or customers or investors, then it doesn't matter how great the product is. Like you still need to be able to sell it and market it, and do it with integrity. Like you said, you can build something and do it the right way or do it the wrong way, and we've seen that in our world happen many times. And I love the honesty around the work ethic piece, because yes, you need to work insanely hard, but you want to do it to the point where you're not dying or everyone around you is hating you. Like you gotta learn to balance some aspects of it, and that's advice that I probably should follow more myself. I'm just too obsessed with certain things, but I hear you. This is a quick message to tell you about my company, Alpha AI. We built Lisa, the world's first AI-powered recruiter who screens candidates for you on autopilot. You can make your recruitment process 10 times faster, 90% lower cost, and significantly improve the candidate experience, all with our AI agent for hiring. Learn more at welovealpha.com or click the link below in the description. And now back to the episode. Okay, but prior to all of this, you founded companies like Bridge, which you grew to an 8-figure exit yourself. So if you were starting a new company today, what market would you bet on?
As a founder, that's a great question. I mean, it's a really dynamic time for all founders. And I think the big, trillion-dollar question that everyone's asking themselves is what value is going to be developed outside of the large incumbents, right? And AI. I guess the short answer is AI, obviously. But like, what can you build within AI that isn't going to be like quickly subsumed by Google and XAI and OpenAI, and what's going to survive long enough for that crucial 5 to 10 years to build a large company, exit it. And so I've put a lot of thought into that over the years, and like I think anything horizontal at this point is really, really hard. I think the large models are getting so good, and there's so much investing, and they're getting so much data now from like their business and consumer products that anything horizontal is, I think, got a 24-month horizon, maybe at best. So if you're trying to build some sort of like, anything horizontal, like a front end development tool, or even like the coding tools, like the cursors of the world, like, where's the defensibility, right?
Yes.
When you're so outmatched in terms of resources, in terms of like just the models, the resources of the models themselves, capital, human capital, and then data. It's going to be really hard. So anything horizontal is really brutal, in my opinion, right now. So I wouldn't be starting anything horizontal. So then we get into the verticals, right? And there's not all verticals are even. I personally now, I guess like a proxy for this is like, where am I placing bets now? Like where I'm placing bets are companies that I would, if the stars align differently, I might be founding. So I'll be looking for really deeply entrenched verticals and defensible verticals. And I think defensibility comes in different forms. So one is regulation. So here at ENIAC and in general, like I'm placing a lot of bets into like digital health, like AI type places, a lot of data interoperability. There's huge spend. There's massive incumbents between the payers, the providers, and patients. And there's so much inefficiency. It's like mind boggling. And there's so much opportunity to increase value, increase outcomes, increase lifespans, increase happiness, increase health. And so I think there's going to be a lot of movement there, but there's also like an insane amount of regulation, and the market dynamics are built on very entrenched incumbents that are extremely good at lobbying, extremely good at protecting their interests. So I think like an OpenAI kind of coming in and like, doing scorched earth into healthcare is a very low chance. I think there'll be certain things that, happen, but even with like mental health, for instance, we're already seeing, I think a lot of people are using OpenAI as a therapist, and it's 24/7 and it's there and it's interesting. And I do think it's helping some people, but at the same time, like there's regulatory issues, and we're also seeing states actually like, create regulation against this. And so healthcare, I think is a big opportunity. Another is like I've been leaning a lot more into defense tech recently. And it's another vertical just due to the nature of the difficulty in selling to the US government and other governments. So there's a lot of kind of, inertia there. And then there's just like a lot of churn there's a lot of defensibility around the government contract. So again, I think like, the big models will be moving into like USG and defense, and they have been, and they will continue to grow there. But I think that again, that's a vertical is going to be relatively protected. So I might be interested in like, if I'm placing bets there, and I might be interested in starting a company there. The other one I think because of a deep domain expertise on my part is I used to be a lawyer. I don't like to talk about it. We all make mistakes. But it's such a huge market, right? Insanely large, like $400 billion a year spent on legal services. And as a former attorney, I can tell you that 90+ percent of what lawyers are doing are going to be done better, cheaper, faster by models today and in the near future, even the more complicated tasks. And so I think that there's a lot of opportunity there as well. So like I've placed bets in like intellectual property law as a vertical, for instance, like which is I think very defensive. It's, you know, one of the most complicated bodies of law. It's extremely technical, and the law is very complicated. So I think that one, you know, I think that one's going to survive and persist, like, you know, longer than, you know, personal injury or kind of more simple things. So those are kind of, there's like three kind of sectors that I like. And then the other one is just like a lot of the bets I've made historically have been contrarian, and then they move into popularity and everyone loves it. But like anything kind of like non-AI right now is
really.
I think there's some opportunities. Yeah, like in fintech and others that, you know, aren't like, you know, everyone's going to have an AI element in it, but they're like what we're thinking is stereotypically like, you know, AI application layer, infrastructure layer type deals. I think there's a large swath of companies that are still going to be building value. They're going to kind of fall outside this paradigm. I think there's some opportunities there as well.
I think by the time this comes out, we'll probably have GPT-5, and you're so right that horizontal AI companies will, like a big chunk of those are going to be gone by the time GPT-5 comes out. Like you need to have a moat with the data, and you described that perfectly. You know, with health, look at open evidence. You know, they've managed to nail that space by having something proprietary that can't just be copied with a model upgrade. Or defense, I mean, Anduro is maybe slightly different, but it's a good example of a fresh startup coming on board and destroying a very legacy traditional way of doing business and getting contracts. Then in legal, look at Harvey. I mean, they are killing it, and there could be a million sub versions of Harvey, each for a particular domain knowledge, like you said. I mean, even in my world, like I have a VC-backed AI recruiter startup, and that's a very traditional legacy industry, similar to lawyers. A large part of that can now be automated using large language models, faster, better, lower cost than what a person can do. And it becomes impossible to compete with if you've got a recruiter doing it traditionally versus a recruiter using AI to screen candidates. So yeah, I'm fully on board, and I really feel like a lot of those highly skilled jobs that you've mentioned will start to become automated using agents as we move from software as a service to service as a software, basically. So look, you have interviewed probably thousands of founders. You certainly reviewed so many pitch decks. What are the common mistakes that you see early stage founders make? You said like 95% of pre-seed startups fail on average. Are there any common trends amongst them that people like mistakes that people are making?
I mean, I think there's two questions there. Like there are mistakes in your deck or your fundraising, and then there's mistakes in like, you know, kind of your business. I'll focus on the former, which I think is what you're asking. Yeah, I think just getting in, I'll start really micro, then maybe get more macro with decks. I think, I mean, at this point, teams are really big. Like, you know, people just put a lot, you know, and this is something that we always talk about. Like we jump straight to the team slide and just really look at the team side. So have it be robust, have it be, you know, not just like a few pictures and a few logos, like, you know, try to go into a little bit of depth there and not just expect like a voiceover, you know, links to, you know, LinkedIn, et cetera. And the other thing too is like, I generally, like decks are flying around, even if, you know, you're using DocSend, the multi-stages just scrape that and put into a PDF and circulate around. So I try to go light on kind of like raise amount or like valuation expectations, things like that. Because like often you're kind of either negotiating against yourself or pushing someone to like artificially pass because they're concerned about valuation or something. So I like to usually, at least in like anything you're going to kind of put out there in public, in writing, I usually try to shy away from like a dollar amount ask or something along those lines. So I think those are two things. And I think just, a robust deck, the more information in there, the better, the higher chance of conversions to meetings with people that are going to not just be wasting your time. So I think like, putting a lot in there, having like a huge, robust appendix with a ton of information, I think is just going to increase the conversion rate of the investors that are most likely to pull the trigger.
Mm. What about the pitch? Let's say the deck lands, you like the team slide, you like the appendix, you love what you see, you meet them. What are there any mistakes that you see founders consistently make when it comes to the pitch itself, like the actual conversation?
No, I wouldn't say there's like universal mistakes, but I think practicing is really key. Like if you ask, just like anything in life, like the first time you do a layup versus the 1,000th time you do a layup, becomes like muscle memory. You get much more natural, confident, you flow better. And so I think practicing with like qualified audiences. So, if you have, the people on your cap table, like definitely, hit them up. And then, if you're designing a fundraise and you're going to get like, several meetings, like have a couple, like don't start with like that investor that you're dying to like get on your cap table, because you're going to be clunky towards the beginning. I can tell, like I usually for several reasons, I like to know how long someone's been fundraising. But one of them is, if they're just going out, it's going to be a lot more clunky, and I kind of give them a little bit of a premium for that. And if you've been fundraising for like 3 months, you've been asked all the questions you're going to be asked, and you kind of work through all the answers and have responses to those that are kind of graceful and thoughtful and steer the audience in the right direction. So yeah, the more you pitch, the better you get, the more confident you get, the more natural you seem, the better your answers are, and the less like kind of gotcha questions you might get. And you're just going to perform better and just kind of instill, inspire more confidence in your audience and in your and the potential investor, and I think have a higher conversion rate.
Okay, let's say you've given them the cash, you've invested. Let's talk about the latter part of that question. What are the common things that you see them make which make them not succeed at the pre or the seed stage? Is there already like one or two things that you consistently see come up in terms of mistakes people are making?
I mean, there's so many ways to not succeed from pre-seed or seed. And, there are some mistakes, but by and large, it's also just like not every product or business or idea is going to succeed. Like it's very, very hard to know once you get the product in the hands of people, what is going to work or not. So I think the art, and I think what everyone should aspire to, and I guess, the contrapositive of this is like, how people fail, is I think the fundamentals of entrepreneurship is timing and graceful iteration, and to the heavier side pivots. And that comes in the form of the business, that comes in the form of the ICP, or like what customers you're trying to sell to, comes in the form of product decisions. And so knowing when and how to iterate and adjust, and knowing to iterate frequently and knowing when to make adjustments is, I think, the fundamentals, is like fundamental of being a good founder. So, if you don't want to too quickly and you don't have enough data to really, enough data points to really have evidence that, a pivot or an adjustment is necessary, and you don't have enough data to really know like which direction to adjust. And if you wait and I guess a common mistake is waiting way too long, just like not giving up. Like, like I think that founders, even first-time founders, there's a feeling that you get when there's an actual pull to your product and versus not, right? And people that are just like, they're out there, they're getting intros, the top of funnel's good, and they're pitching the product, and it's just not converting. And they're getting a few conversions, but it's just like so hard. If it's really, really, really hard, something's not working, and you've got to make an adjustment. And the sooner, the better. And once you kind of come to conviction that adjustment needs to make it, you got to make it, you make it swiftly. And then you're going to have to look at the feedback, look at what you've built. And that's where the art comes in. Are you selling to the wrong customer? Are you selling to like the wrong type of company? Like, you try to sell enterprise, and really like, due to how the complexity of the sale or the security concerns, you should really start in like mid-market or SMB. Or are you trying to sell to the wrong person? Are you selling to the right company, but the wrong person at that company, potentially? Or is it like the wrong features putting up front, or the wrong value prop? A lot of times you can make shifts, even with what you built, around those, make adjustments around those variables, and find success. And get some traction. So I think that's really key. And like, not getting that right is, I think, a very common mistake. And the biggest reason every startup fails is just like a lack of customer adoption. That's really the metric, and whatever form you want to measure that in, revenue or downloads or MAUs or whatever you want to measure. That's really the essence of what you're trying to do, is achieve product market fit in a large defensible market. That's the goal here. And iteration and pivoting is fundamental to that.
Yeah. Let me finish with this. Your most viral tweet was, "I will choose a scrappy startup founder over Ivy League pedigree 1,000 times over," which I love as a college dropout myself. But tell me more about this.
So, pedigree is meaningless to me. I judge and learn and discover people and businesses through first principles, not through like proxies of introductions or proxies of prior investors or prior interest or schools people went to or even companies people worked at. And I think pedigree, like going to, a storied university, there's so many on-ramps to those institutions that aren't merit-based, that in lots of forms and fashion, there's legacy, there's a lot of statues on all of these, famous college campuses, and all those statues have descendants, and all those descendants, in my opinion, tend to seem to have an unfair, an unequitable increased chance of gaining admission. And then also with, pedigree comes entitlement. And I think entitlement is the death of us all, frankly. And it's definitely the death of many startups and the failure of many founders. Like, entitlement gets you nowhere in the startup world. Like, this is a pure meritocracy. I think it's one of the things I love about it. It is all about your hustle and your drive and your creativity and your intelligence. And if you are the smartest and the fastest, with a little luck, you're going to prevail. And where you went to school and where you grew up and who your parents are, all these things don't matter. And I love that about what we do.
Yeah, me too. See, the ultimate sport, the ultimate video game.
Yeah,
cool.
Exactly.
Tim, this has been amazing. For people that have enjoyed it and want to learn more, should they check out you on X, LinkedIn, the fund's website? But where should they go to?
Yeah, all of the above. X, LinkedIn, the fund website. I don't know if we can put that at the bottom here or add that in at the end. But yeah, like, I'm active all those places, and look forward to meeting any and all aspiring founders.
Awesome. Thank you, Tim. Cool.
Yeah, thank you.
Thank you so much for watching. Make sure that you click the follow or subscribe button wherever you're watching, and I'll see you in the next episode.
Introducing Lisa, the world's first AI-powered recruiter. She's an AI agent who works 24/7, screening candidates on autopilot, conducting interviews in 30 different languages, uploading all the best candidates to your applicant tracking system. Hire 10 times faster at 90% lower cost and significantly improve the candidate experience. Visit welovealpha.com to start your free trial now.